Hey everyone, and welcome back. We're diving into something interesting today, building wealth as an expat here in the GCC. I mean, we all know this region has just tons of opportunity, but let's be real for a sec. Figuring out investments can be, well, a little overwhelming.
It's true. You're stepping into a world with like a zillion options. But
Yeah,
that's why we're here, right? To like break it down and give you a clear path.
exactly. And the path we're going to explore today, index investing.
Yeah.
It's a strategy that's gotten super popular, especially with this group called the Bogleheads, who follow the principles of investing legend John Bogle.
Yeah. You know what's fascinating about this approach? It cuts through all that complexity and just focuses on simplicity and long-term growth.
I like that. Okay, so before we get into the how-tos, let's talk about the why. Why are we even bothering with this whole investing thing? What's the end goal here?
It all boils down to achieving financial independence, basically having enough passive income from investments to cover all your living expenses. So think of it as having the freedom to design your life without being tied to a job.
So instead of I have to work, it becomes I choose to work. That's a game changer,
Right.
big time. But how much do we actually need to invest to reach that level of freedom?
A good starting point is the 4% rule. It suggests you need 25 times your annual expenses invested to potentially achieve financial independence. So, for example, if you aim to spend, let's say, AED 200,000 per year, you'd need a portfolio of around AED 5,000 generating that income.
5 million AED. Right, that sounds like a mountain to climb.
It might seem daunting at first, but remember, Rome wasn't built in a day. The key is to just focus on the three core pillars of financial independence.
Okay, lay those pillars on us.
The first one is controlling your spending. So making sure you're spending less than you earn. That's the foundation. The second is finding ways to boost your income, whether it's through promotions, side hustles, other opportunities out there. And finally, it's about investing the difference wisely.
So it's not just about earning more, it's about using what you earn strategically.
Yeah.
Okay, now let's talk about where to actually put that money. We've got stocks and bonds, real estate, mutual funds, even things like gold and cryptocurrencies. Where do we even begin?
There are a lot of options, and each has its own pros and cons. But for GCC expats, one investment vehicle stands out for its simplicity and effectiveness.
Okay, I'm intrigued.
Exchange-traded funds, or ETFs.
Okay, let's unpack ETFs. What makes them so special? Especially for us expats.
So think of ETFs as baskets of assets, like stocks or bonds, that you can buy and sell on stock exchanges, just like individual stocks. And they offer several advantages. For starters, they're incredibly cost-effective. The fees are typically much lower than traditional mutual funds.
So more of our money stays working for us instead of going towards fees. Okay, I like that. What else makes them stand out?
Well, they're incredibly transparent. You know exactly what's inside each ETF, which makes it easy to align your investments with your goals and values.
Transparency is key, especially in the financial world.
Absolutely.
Anything else?
ETFs are also incredibly diverse. You can find ETFs that track specific regions or even the entire global stock market, which gives you instant diversification across hundreds or even thousands of companies.
So no need to put all our eggs in one basket. Diversification is definitely a good thing. Are there any other benefits?
Absolutely. ETFs are highly liquid, meaning you can easily buy and sell them on major exchanges. This gives you flexibility and peace of mind knowing that you can access your investments when you need to.
So no getting stuck with an investment you can't easily sell. That's good to know. What about tax implications?
Yeah.
Especially for us expats.
That's a great question. While there are many popular U.S. domiciled ETFs, they might present tax complications for non-U.S. investors. So a potential alternative to consider are Ireland domiciled ETFs. We can get into the specifics later, but it's just important to be aware of these nuances as an expat investor.
Makes sense. Now, before we go deeper into ETF selection, let's bring back the Bogleheads philosophy we mentioned earlier. How does their approach align with investing in ETFs?
The beauty of the Bogleheads philosophy is its simplicity and focus on long-term growth. They advocate for low-cost index investing, diversification, and staying the course, all principles that align perfectly with the ETF approach.
So it's like they created the perfect recipe for ETF investing. Tell us more about these core principles. What do the Bogleheads stand for?
So their philosophy is built on a foundation of proven investment wisdom, backed by Nobel Prize-winning financial research. First and foremost, they emphasize having a written investment plan. It's not about winging it, it's about having a clear roadmap for your financial journey.
No impulsive investment decisions? just based on the latest market hype.
Right.
I like it. What else is key to their approach?
Well, they also stress the power of investing early and often. The earlier you start, the more time your investments have to grow and benefit from compounding, which is essentially earning returns on your returns.
I've heard of a compounding. It's like a snowball effect for your money, right?
Exactly. Another crucial principle is understanding your risk tolerance. How much market volatility can you comfortably handle without panicking? This will guide your asset allocation, the mix of stocks and bonds in your portfolio.
So we need to be honest with ourselves about how much risk we can stomach. No point in chasing high returns if we're going to lose sleep over every market dip. What else do the Bogleheads advise?
So they strongly advocate against trying to time the market. Trying to predict when to buy low and sell high is a fool's game, even for seasoned professionals. It's far more effective to stay invested and ride out the market's natural ups and downs.
So we can ditch the crystal ball and focus on a long-term strategy.
Right.
Okay, what are some other key principles they emphasize?
Well, they advocate for keeping costs low, which is where ETFs shine with their low expense ratios. They also emphasize diversification, spreading your investments across different asset classes, geographies, and sectors to reduce risk. And above all, they believe in keeping it simple, avoiding complex strategies that can often lead to confusion and, ultimately, costly mistakes.
Simplicity and clarity, that's music to my ears. But I have a feeling the most challenging principle is their emphasis on staying the course.
You're absolutely right. Staying disciplined and sticking to your plan, especially when the market gets turbulent, can be incredibly difficult.
It's easy to get caught up in the fear and excitement of all the market swings.
Mm.
Why is staying the course so crucial, especially when things get rough?
Well, it's crucial because reacting emotionally to market fluctuations can lead to really costly mistakes. Selling out of fear when prices drop means locking in losses and potentially missing out on the subsequent recovery.
So panic selling is a big no-no.
A big one.
Got it. But how do we actually stay calm and rational when our portfolio is, like, taking a hit?
That's where understanding some key market realities can be incredibly helpful. So let's dive into some fascinating facts that might just change the way you think about investing forever.
Okay, I'm ready for a dose of reality. Hit me with those market facts.
Okay, so first, let's address the elephant in the room. Volatility. Fact number 1. The stock market always rises over time. I know it sounds unbelievable when you see all those headlines about crashes and corrections, but history shows an upward trend in the long run, despite, all the bumps along the way.
So those short-term dips, they're just part of the journey.
Exactly. Think of it like a roller coaster. There will be thrilling drops, but ultimately you end up higher than where you started.
Okay, that's a reassuring way to look at it. What's the next market reality we should kind of keep in mind?
Okay, fact number 2. No one can accurately predict short-term market movements. All those financial gurus out there making bold predictions, they have a 50-50 chance of being right, just like flipping a coin.
So we shouldn't be basing our investment decisions on, like, someone's hot take or a gut feeling.
Definitely not. It's more likely to kind of lead you astray than to success.
Okay, noted. What's next on our reality check?
Okay, fact number 3. Market corrections, those dips of 10% to 20%, happen on average once a year. They're just a natural part of the market cycle, like a breather before the next climb.
So we should expect them to happen and not freak out when they do.
Precisely. And remember, corrections are usually short-lived. Historically, they've averaged about 54 days.
Okay, starting to see a pattern here. The market likes to keep us on our toes, but it tends to bounce back. Okay, what's fact number 4?
All right, so fact number 4 is that only 1 in 5 corrections turns into a full-blown bear market, a drop of 20% or more.
So most of the time, those dips are just like temporary blips on the radar.
Exactly. And if you panic and sell during a correction, chances are you're selling right before the market recovers. So you're turning a paper loss into a real one.
Ouch. That's not the outcome we're looking for. Okay, hit me with fact number 5.
Okay, fact number 5. Bear markets happen every 3 to 5 years, on average. They're a bit more intense than corrections, but still, they're a natural part of the cycle.
So even those big drops that make headlines, they're actually pretty common in the grand scheme of things.
That's right. And historically, every bear market has been followed by
A bull market. That's fact number 6,
Right.
right? A period of rising prices.
You got it. Every single bear market in history has been followed by a bull market.
So if we stay invested through the tough times, we're positioned to benefit from that recovery.
Absolutely. Which brings us to our final and perhaps most important market reality.
Drum roll, please.
Fact number 7. Staying invested is the wisest strategy. It's not about trying to time the market or outsmart everyone else. It's about trusting in that long-term upward trend and letting the power of compounding work its magic.
Okay, I'm convinced. Staying the course is key. But honestly, it can be so hard to ignore those emotions, when the market takes a nosedive.
You're right. It's human nature to feel fear and uncertainty. But that's where understanding these market realities can really help. Knowing the historical patterns can help you make rational decisions instead of emotional ones.
So knowledge is power when it comes to overcoming those investment jitters.
You could say that. And remember, you don't have to go it alone. Building a supportive community of, like-minded investors can provide encouragement and shared experiences. We can talk more about that later.
Great advice. We've covered the Boglehead's philosophy and those crucial market realities, but how do we actually put this into practice? How do we build a solid investment plan as expats in the GCC?
So let's break it down step by step. The first thing is to define your financial goals. What are you aiming for? Is it early retirement, financial independence, buying a property back home?
Good old goal setting, always a solid starting point.
Right. Once you've got those goals in sight, you need to figure out your time horizon. How long do you have to reach those goals?
So if I'm aiming for early retirement in 10 years, my approach will be different from someone who's planning for retirement in 30 years.
Exactly. Your time horizon is going to influence your investment strategy. Typically, a longer time horizon allows you to take on more risk.
Makes sense. What's next on our investment plan checklist?
This is a big one. Assessing your risk tolerance. How comfortable are you with market fluctuations? Could you handle, let's say, a 20% drop in your portfolio without hitting that panic button?
That's a tough one. It's easy to say you're a risk taker when the market's going up, but things can feel very different when things go south.
You're absolutely right. Being honest with yourself about your risk tolerance is crucial. It will determine your asset allocation, that mix of stocks and bonds in your portfolio.
So if I'm a bit more risk averse, I might opt for a larger portion of bonds, which, tend to be less volatile than stocks.
That's a common approach. Bonds can provide stability and balance, while stocks offer that potential for higher growth.
Got it. So we've got our goals, our time horizon, and our risk tolerance figured out. Now what?
Now comes the fun part. Choosing your investments. And remember, we're big fans of those low-cost, diversified ETFs.
Let's talk ETFs. What are some key things to consider when selecting these baskets of assets?
Okay, first, consider your investment strategy. Are you looking to invest in, let's say, a specific region or sector? Or do you prefer a broad global approach? There are ETFs for every investor.
So if I'm bullish on emerging markets, I could find an ETF that focuses specifically on those regions.
Absolutely. And if you're looking for broad diversification, there are ETFs that track the entire global stock market.
It's like having the world at your fingertips. What other factors should we consider when choosing ETFs?
So once you've narrowed down your strategy, it's time to do your research and compare different ETFs that meet your criteria. Pay attention to the expense ratio, which is the annual cost of owning the ETF. The lower, the better.
So we're looking for those lean, mean investing machines.
Exactly.
Anything else we should be looking for?
Absolutely. Look at the ETF's liquidity, which refers to how easily you can buy and sell shares. Higher liquidity generally means smoother trading.
So no getting stuck with an ETF that's, hard to trade. What about dividends?
You're right. Dividends are another important factor. Pay attention to the ETF's dividend yield, which is the annual dividend payment as a percentage of the ETF's price. This can provide a nice stream of passive income on top of any potential capital appreciation.
Okay, feeling more and more like an ETF pro, but how do we actually buy these ETFs?
That's where brokerage accounts come in. These are platforms that allow you to buy and sell investments, including ETFs.
So like our gateway to the investment universe.
Precisely. Choosing the right brokerage account is important for a smooth and cost-effective investing experience.
What should we look for in a brokerage account? What are the key factors?
Fees are a major consideration. Brokerage accounts can charge commissions per trade, account maintenance fees, inactivity fees, and more. You'll want to find a platform that aligns with your trading style and keeps those costs low.
Nobody likes hidden fees sneaking up on them.
Exactly. Pay attention to the platform's user interface. Is it intuitive and easy to navigate? Does it offer the research tools and features you need?
What about security?
Security is paramount. Ensure that brokerage account offers robust security measures to protect your investments.
Okay, so we've chosen our ETFs, we've set up our brokerage account. Are we ready to jump into the market?
Almost. There's one more crucial step: determining your investment schedule. How often will you invest?
Should we be, like, trying to time our investments to catch those market dips?
Remember, we're not playing the market timing game. The Bogleheads and, most financial experts recommend dollar cost averaging. This involves investing a fixed amount at regular intervals regardless of market conditions.
So no need to stress about, like, predicting the market's every move.
Exactly. Dollar cost averaging helps smooth out those ups and downs and ensure you're buying at a variety of prices.
That sounds like a smart and less stressful approach. We've covered a lot of ground today, from the basics of financial independence to the power of index investing, ETFs, and the importance of staying the course.
It's been a fantastic discussion. And remember, this is just the beginning of your investment journey. There's always more to learn and explore.
Absolutely. But how do we stay calm and avoid those rash decisions when our portfolio takes a hit?
There are a few strategies that can help. First, remind yourself of those market realities we talked about earlier. The market, it's always recovered. Eventually, corrections, bear markets, they're just, a natural part of the cycle.
So we need to, like, zoom out and look at the big picture instead of getting caught up in those day-to-day fluctuations.
Exactly. Focus on the long term. Okay, and second, go back to your investment plan. Remind yourself why you chose this path in the first place. What are those goals? What's that time horizon?
So, like, having a financial anchor to kind of keep us grounded during those market storms. We've covered a lot of ground today, from, like, the basics of financial independence to the power of index investing, ETFs, and the importance of staying the course.
It's been a fantastic discussion. And remember, this is just the beginning of your investment journey. There's always more to learn and explore.
Absolutely. So for our listeners out there, what's one step you can take today to start building your path towards financial independence? Maybe it's, defining your goals, researching ETFs, or even just, like, having a conversation with a financial advisor.
Whatever that first step is, take it. And remember, you don't have to navigate this alone.
That's right. We're all in this together. And we'll continue to be here sharing insights and practical tips to help you navigate the world of investing.
So keep learning, keep growing, and keep investing in your future.
And don't forget to subscribe for more deep dives into the world of finance and investing tailored specifically for expats in the GCC.
Happy investing, everyone.